Hello and welcome to another edition of the Sunday segment. This is where I break down the 3 biggest financial news stories this week. This week, we're going to talk about the Tesla stock split, the Berkshire Hathaway stock buyback, and the UK falling into its deepest recession ever. So let's get going with the video. As always, don't forget to hit that like button and hit that subscribe button so you don't miss out on any videos, and especially the Sunday segment. On Tuesday, Tesla announced it was going to split its stock 1 for 5. This meant for every 1 stock that a person holds, they'll get 5 stocks. This is going to happen at the end of August, and as a result, the price of the stock rocketed by over 20%. Now, a bit of background about Tesla. Tesla is an electric car company run by genius billionaire Elon Musk. He owns SpaceX, who recently sent rockets to the International Space Station, and a boring company which is drilling a hole under LA. Tesla, however, is a car company which specializes in electric cars. Over the course of the year, Tesla's stock price has quadrupled. From the start of the year, where it started at $430, to the close on Friday night at $1,650. So as a result of this stock split, every share that is held will be split into 5, meaning that an owner will own 5 shares. Nothing has changed in the company fundamentally. The market cap, so the size of the company, is still exactly the same, just the number of shares outstanding has times by 5. So just imagine it if this was a pizza. Instead of cutting a pizza into 10 slices, it's now been cut into 50 slices. The company is still the same size, it's just cut into smaller and smaller slices. This is because Tesla wanted to make it more accessible for employees and retail investors to invest into Tesla. This is very similar to what Apple did back in July, where it announced a stock split of 1 for 4. After the announcement on Tuesday, Tesla's share price has increased by a whopping 20%. So why does a stock split matter, and why has the price increased so much? Well, in reality, nothing has changed. The company hasn't announced that it's making millions more cars or billions more dollars in profit. All it's done is it's cut this big pizza into more slices. Therefore, in reality, just by doing the maths, the share price shouldn't increase. However, this is more than just a financial issue. This is a psychological aspect of investing. When you see the price of a Tesla share at over $1,600 a share, people consider that expensive. And it can be incredibly difficult for beginner investors or people who just don't have that money to buy 1 share of Tesla. However, by splitting it, and now it's down towards $300 a share, it means that just psychologically, it looks cheaper. And because it's cheaper, it means that more people are more likely to buy it. Just by doing the maths, you can see that the company hasn't changed. However, the stock market has appreciated by 20%, just because in some future date, that share price is going to be cheaper, but there's going to be more shares about. This just shows how irrational the markets can be at times. And this is why every single investor needs to understand that the markets aren't sensible all the time. They can be irrational. People can flood into an investment like Tesla over the past few days just because of the promise of a cheaper ticket. It has nothing to do with the value of the company, so you should always do your own research. The company has not become more valuable, and to be quite honest, it doesn't make sense for the price to have rocketed so much. The lower share price might mean that more people actually look at the stock, mainly because they might have had the funds to spend over $1,000 per share on the company. However, on a value front, the real value of the company hasn't changed. This news story just highlights how markets can be irrational. It's a great lesson for all investors to really see the price appreciation of Tesla and understand why it's appreciating. That it isn't actually appreciating for the business side, it's just that the shares have become cheaper. The next news article this week is Berkshire Hathaway buying back $5.1 billion worth of stocks. Berkshire Hathaway, the legendary investment company run by Warren Buffett and Charlie Munger, spent their huge cash pile to buy back their own stock. So a little bit about Berkshire Hathaway. Berkshire Hathaway is run by 2 legendary investors, Warren Buffett and Charlie Munger. Both of these guys have been investing for decades. And what these guys haven't seen is not worth knowing about. They have bought companies, sold companies along the way, and both of them are billionaires. So these guys know a thing or two about investing. And if you don't know about Warren Buffett, Berkshire Hathaway and Charlie Munger, then do some Googling and find out. I really enjoy these guys and look up to them as guiding lights in the investment world because they've been there, done it, and got the t-shirt. So during the COVID-19 pandemic, shares in Berkshire Hathaway dropped 40%. This is because Berkshire Hathaway is a holding company and invests in other companies in the stock market, such as American Express, Apple, or Bank of America. As the stock market declines, Berkshire Hathaway, known as a value investor, normally looks to buy assets. This means that a decline, such as what happened in March and April, would be perfect for them to invest. However, they only bought a small amount of Bank of America stocks, only about $2 billion, as that was the only real big purchase that it made, shows that they didn't really see very much value. However, they did use their huge cash pile of over $140 billion to buy back just over $5 billion of their own stock. This is really interesting because Warren Buffett is known for buying things which are undervalued. So when the price crashed on his Berkshire Hathaway stock, he took advantage because he believed that his Berkshire Hathaway was worth more than the stock market was saying it was worth. I truly believe that other investors, when looking at professionals and legendary investors such as Warren Buffett and Charlie Munger, should really take note in what they're saying and what they're investing in. It's really interesting that he's buying back Berkshire Hathaway stock, because similar to the Tesla example, all they've done is they've taken the same pizza and if anything they've sliced it into fewer slices. It means an investor in Berkshire Hathaway will have a larger slice of the potential profits. Share buybacks are great for investors because they just get more and more money from the profits of the company, which means that if you're an investor in Berkshire Hathaway, most likely you're feeling pretty pleased with what's going on right now. And it also highlights to the investment world that there aren't that many bargains out there. While central banks have been helping the economy and asset prices and stock markets have returned back to close to their levels at the start of the year, it means that investors are struggling to see where the value is. And value investors who like to buy things cheaply and hold for the long term whilst the stock market catches up aren't necessarily seeing the value that they need to get excited about an investment. And the final story this week is the UK falling into recession for the first time since 2009. Gross domestic product in the UK shrank by 20.4%, which is the most since 1955 when records began. This is because the UK, like other countries around the world, entered into a lockdown. It's because bars were closed, shops were closed, and people started working from home, meaning that the economy ground to a halt, leading the UK into a recession. So firstly, when someone says recession, alarm bells ring. It takes us all back to the great financial crisis in 2009, where all everyone spoke about was recession, recession, recession. So what is a recession? Well, a recession, in a technical term, is 2 consecutive quarters of negative growth. The UK suffered from negative growth from the 2 quarters from January to March and then April to June. From January to March, the UK economy shrank by 0.2%. And this was followed by a 20.4% negative growth in April to June. This meant the economy was hit extremely hard. Construction fell by 35%, government spending was cut, and productivity was lower. This is because people worked from home and weren't able to work because of lockdown restrictions. So what does this mean for the UK in the long term? Well, obviously a recession is never a good thing, and we haven't had one for just over a decade. So what will likely happen is there will be job losses, unfortunately. As the furlough scheme in the UK comes to an end in October, we'll start seeing the full picture of unemployment in the country. At the moment, it's hard to tell exactly who's employed and who's not employed because people are supported by the furlough scheme. Also, there is a potential of a credit crunch. A credit crunch is where really banks stop lending. Banks start giving mortgages, credit cards, personal loans, car loans. So people can't go and spend money. Without the banks lending money, it means the economy could just grind to a halt. One thing that has been mentioned that could help us all out is the central bank in the UK, the Bank of England, could introduce negative interest rates. This could help encourage the economy to keep moving and banks to keep lending, but we'll have to wait and see about that one. Overall, this is not a good thing for the UK. The UK has contracted more than any other country in Europe and has been hit really, really hard by the coronavirus. As someone who lives in the UK, I don't know how this will turn out, but I watch this data with great interest. Returning back to normal will obviously help, but who knows how long that will be given the current pandemic. So this could be difficult in the long term, but let's wait and see. Well, I hope you've enjoyed today's video, and let me know in the comment section below what you think of today's financial news stories that I've covered, and what other financial news stories that you've read this week that you found particularly interesting. And as always, before you go, make sure you hit that like button and hit that subscribe button so you don't miss out on any further videos. And see you next time.